So, good morning, everybody. My name is Stefan Spang. I'm a senior partner with McKinsey, and as Paul Benson said this morning, I'm an independent director on the board of the AESC. It is my absolute pleasure to introduce to you Liz Hilton Segel, a dear colleague of mine. She is one of the most accomplished leaders of McKinsey & Company. She is a member of our global board of directors. She leads our marketing and sales practice in the Americas, and she is also a member of the global leadership team of our technology, media, and telecoms practice. In addition, she is on the board of one of our software-based solutions. So with all those vectors, you can imagine that her work is exactly at the intersection of all the topics we are discussing about this morning. Now, given Liz started her career with McKinsey in 1992, which is hard to believe, especially if I think that I started in the same year, she has also had the opportunity to see all those developments evolve over a few decades. Today, Liz will speak to us about winning the growth triathlon. Please join me in welcoming Liz on the stage.
Well, that was quite the introduction. He didn't tell you about my dog and my parakeet. No, I'm just kidding. I'm really thrilled to be able to share some of our thinking on growth and literally what does it take for a company to grow disproportionately and therefore increase its value. I'm hoping that the take of all of that for each of you will be what it means for the talent implications. What does it mean for the kinds of skills and capabilities that your clients might seek out? What might it tell you about their biases in terms of the kinds of executives they tend to promote and the types of executives they tend to look for? In our work, we see growth programs through a lot of different industries. And sometimes revenue growth comes from things that are exciting, so a new product launch, a new digital experience. There's a lot of talk of things these days that are effectively razzle-dazzle. But a lot of growth is also just nuts and bolts. It's just about, is the sales force more effective? Is the pricing optimized? Are we more efficient with our marketing dollars? So growth comes in the form of sexy new things, but it also comes in the form of the basics of blocking and tackling and execution. And I want to just give you a sense of how we think about helping clients catalyze organic growth. What I'll tell you, and I hope that this is your experience, I hope this resonates, I'm stunned by how many companies don't actually pay enough attention to growth. Like, simply put, growth equals company value, and I'll show you that mathematically. But given the fact that growth equals company value, which also means that it equals their compensation, it just boggles my mind that so many companies actually spend more of their time focused on cost and earnings. And so you can see, I am like the proselytizer of the topic of growth, because I really do think for most companies, there's more growth out there to be had if more attention were put to it. So here we go, my purposeful growth roadmap. Okay, so the first point just comes from some research the firm did many years ago, and basically the point is growth matters. Growth determines whether over the long run a company actually survives. So companies that don't have material top-line growth either in the end get bought or they'll get delisted. So it's worth paying attention to. The second point is growth is quite hard to sustain. So if there is not a constant and continuous focus on it, it is very, very hard to sustain over the long run. And just as it relates to this concept of how growth really affects company value, this is just a super simple sort of mathematical formula to show you. So this is a disguised example of an actual company. Imagine that we've indexed all the numbers, but imagine the company starts at a stock price of $100, and they have currently 2% organic growth, and they have operating income margin sitting at 6%. If they can take the 2% organic growth from 2% to 4%, it literally is a 28% jump in the stock price. So if you said to yourself, Why would anybody in the top management team spend their time focused on anything else? Not to say they don't have to hold margins, not to say they may not need to increase margins, but that movement alone from 2% growth to 4% growth is literally a 28% jump in the value of the company. So what's different today? So, the message, which is growth is important, growth should be the priority for a management team, that's not new. That is, in some sense, a truism. And I'll share with you some of the firms, I'd say, sort of slightly older research on the thinking around how to ensure a company grows. But what's different today is that, basically technology is literally changing everything. So whether technology is changing everything in the form of digital literally making industries collapse, and Stefan mentioned that I've done quite a lot of work in the media industry, so I've witnessed collapse firsthand. So whether it's in the sense that the economic structure of the industry collapses, or whether it's in the sense that a new digital experience completely changes customer expectations, or whether it's in the form of analytics, like the possibility to find new insights and to manage customers at a much, much more granular level is possible. So things are changing. It doesn't mean to say that growth is less important. It means to say that the bar for how you go about creating growth is rising. So this is our roadmap. It's three components. The physics, so sort of the firm's I'd say wave one thinking on growth basically had a single thesis, and that was it really matters where you play. And the reason it matters where you play is because it is difficult to defy the physics of the market you're in. So if the market you're in is growing at 2% and you want to grow at 8%, there's a fundamental disconnect there. So you need to be quite smart about where you play. So that's what we'll call the physics of growth. The mechanics of growth is some of the thinking that we've come out and published on quite a lot recently. And I'm going to introduce to you this concept, which is there are what we see as three different muscles that you typically see companies and executives applying towards creating growth out of their current position. And then the third thing is just around the enablers and just the whole idea of how does the company work together to achieve a new growth outcome. So just starting on the physics. So the physics is essentially your starting position. It's about gaining an understanding of what the cards are in your hand. And the mechanics will get into the question of how you play them. And one of the things that I talked about is this idea of, let's say you have an overall industry growth rate of 2% and you aspire to a company growth rate of 8%. That feels like an impossible outcome. But one of the insights that we've had is that you really can approach it from a more granular perspective. And what a granular perspective means is really understanding the segments within your portfolio. So the segments that your company is exposed to and which within these are growing faster. So let me just show you an example of how that might come to play. So this is an example of a food company. And what you'll see is we're just giving you a very simple depiction of a few of their countries and a few of their categories, and the acknowledgement that if you look at that level, you'll find really very widely varying growth rates at the segment level. And so once you've gotten that understanding, it might make you say, well, maybe our allocation of spend, in whatever the form that is, shouldn't be whatever it was we did last year. It should be relative to what the potential is of that market based on its current growth rate. So that's sort of the starting position. The starting position is you have a point of view about, given who you are as a company and given the underlying industry growth rates of the markets that you have access to, where is it that you want to play? And then you have the question of, how do I go after it? So this is how we think and talk about it. We think and talk about three different approaches to growth. The first is the investor. The second is the creator, and the third is the performer. And what I'm hoping is that as I give you sort of a little bit more color on what each of these growth muscles look like, you might think about companies and executives that you know, and think about, do they in fact tend to bias towards one of these approaches than another? And could you in fact be a catalyst for helping them think about diversifying their approach? And if they did diversify their approach, would that lead to very positive outcomes for their company? So Neil Smith is someone I know extremely well. He has a long career across industries. He was at Nabisco in Latin America early in his career, and then he led AOL during its real expansion and rise in customers, and then he moved into the cable industry where now he is the vice chairman of Comcast. And what's notable about him is that during his entire career, I watched him take a company that was more or less at a standstill from a growth point of view and literally pivot it within usually somewhere between 4 and 6 quarters to growth in customers, growth in revenue, and growth in earnings. And he did it with unbelievable discipline every single time. It really was a thrill to experience it with him. So I wanted to give you a chance to hear a little bit about his philosophy on growth.
Well, I think first is getting alignment of the whole organization on the subject of growth. And they have to believe it, and they have to live it and breathe it. And it's just play offense all the time. And it's a lot more fun than defense. A healthy business is growing the top line. Expenses are easy. If you're getting top line growth, you're buying time to look at expenses. It's not a question of if you're going to grow the business, it's just a question of how. The investor is always looking at what else can I do with what I have. So when I came in, one of the first things I told my boss, Brian Roberts, was we need to invest more in HSD. It's a high margin product. We're underpenetrated, and that's the product we have to drive the hardest. In our budget reviews with the divisions, what became the standard question that they knew I was going to ask was, can't you take more money out of admin and put it into marketing? Where else can we find money to put into marketing? As a creator, we created the X1 voice remote, which enables you to get to your content quicker. You don't have to go through various screens to get to your content. You just say either thematically or by actor or by title or by genre what you want, and it gets you right there. We've got 10 million of them out now. 250 million voice commands a month, so it's a really very highly used and great product. It's always important to have 3 to 5 new bets in motion because they take time to develop, and you've got to be working the core while you build the new growth opportunities and the next billion-dollar businesses. In terms of performance, my personal favorite. We're driving the online channel, which was 3-4% when I got here. It's now pushing 20%. It's the most efficient, lowest churn channel, and we really didn't have any presence there. And we looked at the stores, and the stores were just payment centers, and we weren't doing any sales through the stores. So we've converted now 180 stores in the last couple of years, and their sales are up 20% year over year. I think we've become much more of a product and technology company. We have agile development and DevOps, and we've changed the teams around quite a bit, so they're very nimble. And we build products, test them, and launch them at a much higher frequency rate. I think last year we launched 40 some odd products, and in previous years we launched 3 to 4. And a lot of that required us getting everything up in the cloud, so we had to put the infrastructure in place.
It's fun always for me to hear him talk about it and remember it. What's interesting is if you follow the evolution of his career, I think in his Nabisco days, there was more of the creator in him, but really through the core of the middle of it, he was much more of a, as he said, performer and investor. He's a guy who drives things. He always believes there is another turn of performance that's possible in the company, and he has an unbelievable capacity to get his entire organization lined up against an outcome. Even if they think the outcome's impossible, they'll do it because he believes it's possible. But it's interesting to hear how much he talked about creator and about product and that whole pivot of 4 launches a year to 40 launches a year. And I think that was very much because of the partnership between Brian Roberts, who's the primary owner of the company and the CEO of the conglomerate, and Neil, who was running the cable division. So the other, I think, theme that's interesting to reflect on is how different management teams work together to play on each other's strengths and to be conscious of, is the entire part of a management team tend to a certain posture, and there's really no one who bears the voice of a different path to growth in the team. So, what I wanted to invite you to do was to think about a couple of your clients and to say to yourself, like, knowing them and their business, what has been their path? Like, what have they done to drive growth in the past? And then just think about that and think about what that means in terms of the talent that they need to be successful. And we'll revisit that question a little bit in a few minutes. So just to dive in on the investor front a bit more, what does an investor do? I mean, an investor has a very clear sense of what a marginal dollar of investment, and that can be in capital, in a retail example, that's typically in another outlet being built out. In a credit card business, that's typically in the form of incremental marketing dollars being spent to acquire customers. But they have a very clear sense of what is that marginal return from incremental investment. And there is a bias in the company to source new funds regularly. So there's a restlessness about the sourcing of incremental funding for growth. And there's an overall sense that that is what we do for a living. We source incremental funding for growth, and we apply it to grow the company more aggressively, as opposed to we're always under the gun to deliver incremental savings for earnings that'll get handed back to investors, in the form of greater earnings and cash flow. So that's the investor mindset. In that type of business, you typically see the CFO playing a very, very active role in the company's aggregate growth profile, and there's a posture around investment behind growth. And this is a pretty recent case. I used to tell a story about Geico because they really did disrupt their industry and how aggressively they invested in direct sold insurance. But this is a bit of a more recent case, just looking at Chase, who really went on the attack in the premium credit card market. And they went on the attack against American Express, and they were very purposeful. They were very clear on what is an affluent card member worth, what am I willing to pay to basically buy that affluent card member? I'm going to deliberately go and pick up market share in the category. And they came out with some things that blew people in the industry away. So they offered 100,000 points, which is the equivalent of $1,500 in travel when you think about the redemption value of 100,000 points. They came out with that offer, and the thing, it just blew the socks off the category very quickly. They literally, they exceeded their 1-year goal in 12 weeks. They physically ran out of the metal required to print the cards. And there was just an uproar extraordinary about it. They put zero marketing dollars behind it. So the entire thing flew off the shelves simply on the quality of the offer, because there had been so much investment put behind the acquisition benefit, which was handed straight to the consumer in the form of this $1,500 credit, and it was a $300 travel credit as well. And so how did they fund it? They funded it because the traditional way of thinking would have been more over-the-air advertising in the form of TV advertising, and they transitioned that to more of a digitally oriented campaign. And they did go after core G&A savings in the business in order to fund that. In February of 2018, they announced that their overall credit card business grew by 13% in a category that's probably double the category's growth rate. And the Reserve card, the renewal rate on that card in particular is 90%. They've publicly reported that it was 90%. And their spending per account, which is a huge driver of profitability in the industry, is 6 times higher than the industry. So I just think this is a really recent and clear example of somebody choosing to go on the attack in a category and doing it by investing. The fundamental value proposition of the card is very similar to what exists in other premium products in the market. But they did it by investing, and they put that investment into the customer directly. So the second, sort of growth approach or muscle is being a creator. And I remember an executive at a retailer just said to me, completely deadpan and definitively, we don't grow without new categories. And that was totally contrary to what I had thought at the time. What I had thought at the time was, the way you grow is you either spend more or you make your channels more efficient. That was my mindset, because I had done mostly my work in telco and financial services. And he's like, that's not how it works here. The channel is what it is. The way we grow is I start selling new stuff. And I need new stuff. And if nobody's giving me new stuff to sell, it's impossible. I was like, okay, I hadn't thought of that before. And in a typical creator mindset, what you'll see in those companies is just fantastic consumer insight capability, and sometimes that's sophisticated data analytic and quite quantitative, and sometimes it's actually much more ethnographic and intuitive. But they're very focused on what is the underserved need in the market, and how can I capitalize on the underserved need in the market. And they also typically have a really rapid innovation culture. So innovation is less about birthing a baby in 9 months and more about like what's the sprint you can get accomplished in a week. And I think, you know, in our modern life, in the modern life, Apple is the iconic example of that, in the sense of just the range. Like, we just think of the level and the scale, the breadth and depth of their product portfolio, and how much that has scaled over a short period of time, and how tightly correlated that has been to their revenue growth. So they're, I think, a pretty iconic example. But another one that's a more recent story, and it's being talked about a bit more now, you know, is McDonald's. So they were in a pretty bad spot. They had about 0%, that does not go at all with my, where does the stock price go? Like 0%, that's terrible. 0% same-store sales for about 3 years between 2013 and 15. And starting in 2016, they began on an innovation tear. And the innovation tear was certainly around the core product, like as in, you know, what are you offering? So what can I do to change the menu? How can I make literally the hamburger itself or chicken? How can I make the menu more relevant to people's current lives? But they didn't stop at changes to the menu. They thought quite a lot about how to change the experience. And they have what they call the Experience of the Future initiative, which includes self-service ordering through kiosks. It includes table service. They now have mobile ordering and a pay app. They actually have delivery. So in Asia, 10% of all revenue in Asia is actually driven by delivery. And so they're just, I think, a great example of how both core product and experience innovation can really lead to a step change in growth. And that the outcome of this is a 5% lift in their growth rate. Okay, so from 0% to 5% leads to a tremendous impact on company value. So the last approach is the performer. And Neil talked about this. This is, if you thought of, you know, the days of lean manufacturing, this is basically same concept but applied to the commercial system. And that can be the commercial system in the sense of sales, marketing, and pricing, or customer experience, but also can be in the sense of things like inventory availability. So like when I try to go to buy something, is it actually available to sell? You know, this is probably where we as the firm, McKinsey, do most of our work around growth, because it's the most immediate in terms of impact and realization. And it's not uncommon for us to see a lift of 5 to 10%. So a lot of times when companies want to get moving on a growth agenda, the easiest thing to do is to start here with optimization of what is today. Why Neil comes from telco, which is a place, the sort of cable industry fighting with the telco players and wireless, and now all the OTT players, is a market I know quite well. You know, that whole industry was literally sleepy. They did not really think of themselves as being in a competitive marketplace. They were relatively protected from a margin point of view and a cash flow point of view, and there was just no orientation around growth. And when Neil came into Comcast, it was now many years ago, he really changed things up, and he just totally changed their mindset about what would be possible and what was the expectation of performance. What I'm seeing now is you see much more of people leaning heavily on data and analytics to try to do things they haven't done before. So, you know, an example of things that people are doing now that just wouldn't have been thought of is the idea that, you know, literally every SKU on every day of the week, potentially to any person, can be repriced differently. And it can be repriced differently based on an actual fact-based understanding of whether, if I take the price up, will volume stay the same so I'll get more revenue, or if I take the price down, will volume exceed expectations and therefore I'll take revenue up. And that ability to be data-enabled or data-assisted in very everyday decisions and very distributed through the company is the thing that we see people really trying to get advanced in. So that leads me back to a question for you, which is in the same way I said, you think of a client, Think of how that client has grown in the past, what's been their formula in the past. If you think to the client's future and to where their industry is going, what the competitive context is, and what the opportunities for them, do you see a pivot in the formula? Do you see them needing to pick up a skill set that they traditionally haven't had? Would you encourage them to diversify their approach to growth? How is, again, whatever framework you use, whatever language you use, how is their point of view about how they'll create growth in their company directly translating to the talent agenda at that company? And so we went out and asked, I had this hypothesis from my work and from the work of my colleagues that people do have real biases, that literally people, individuals have biases based on what has been their own success formula, but also that companies end up in a bias. Their processes and the sort of cultural norms of the company get them more used to a certain groove. We went out and researched, and it turns out that's not true. It turns out that the best growers do at least two of these things. So you can see the distribution in terms of invest, create, perform, and then folks who have approached it with multiple paths. And in a sense, multiple paths is the winner in a volume sense. We also found that it's the most correlated to folks who have a disproportionately high growth rate. And what we've started doing, and we're very, very early days in this, but I'm pretty excited about it, is we created an AI tool to analyze both investor presentation transcripts and articles written about the company to try to understand whether we can see patterns in different industries. And so this just happens to be an example from specialty chemicals where some folks started to say what is the bias we see in the industry in terms of the approach to growth. And so in this example, what you could see is that the performer approach is by far the most common in terms of what's talked about publicly in terms of how specialty chemicals players go after growth. And what we're going to start doing is applying this to, is it different in financial services? Is it different in consumer packaged goods? Is it different in telco? And see if we can see trends in terms of what types of leadership profiles would be most complementary to the industry's heritage and what types of leadership profiles might help to take an industry or a company into a new direction. So just to close, let me just talk a little bit about enablers, because the very first thing around mechanics just starts with this premise of if you put your business into a slow-growing domain, you're not going to grow. It's just not more complicated than that. If you put your business into a fast-growing domain, you're going to grow. So in general, try to put your business into a faster-growing domain. The second thing is this whole question that I've been going through, which is, okay, given that reality, what is the best path to get growth? Are you going to do it by spending more? Or are you going to do it by optimizing performance? Are you going to do it by launching a new product set? But underneath whatever you do, wherever you are and however you approach it, there are a set of enablers that we really feel need to be in a company in order for them to be successful in sustaining a shift in their growth rate over time. The first one is alignment, the second one is capability, and the third is execution. And why we emphasize them is just because when we reflect on our work with clients, what we'd say is that when they undergo a transformation, where they're really trying to make a shift in performance, not dissimilar from the McDonald's example, where we're going from 0% to 5% in terms of a shift in performance, many of them fail. And they fail because people get tired. They fail because there isn't the rigor in the organization. They fail because there isn't the follow-through. And so what we said to ourselves is, well, how might you combat that? Like, again, what are the traits that the leadership team needs to demonstrate that will combat that sense of fatigue that leads to failure? So the first one is just around alignment. So our view is that a successful transformation starts with a super compelling change story that says why change and what are we intending to do, and we're all lined up and excited about it. And same thing, my experience is some senior executives are fantastic at galvanizing their organization around a change story, and some are terrible. So the question there is literally, what do you do with that? Like, who is the team that you've got? Who's the team that's leading this, and who is going to be most compelling and consistently and in a galvanizing way, usually around the world, mobilizing people behind the change story? The second thing, and this is a place where, as a firm, we're leaning into quite heavily, is just acknowledging that capabilities typically need to change. So in order for an organization to grow, they're often trying to develop a skill set that has historically not been there. So one that I have personally experienced quite recently is just the whole trend towards agile. And what does it mean to make an organization literally agile? This could be agile in their marketing approach, it could be agile in their product development, but how do I actually take a company that isn't agile and make them agile? This is one example of a capability change. But just having a roadmap that says, okay, if this is what I'm trying to achieve in terms of the shift in my growth rate, if these are the types of initiatives I want to take action against, what does that mean in terms of the capability change in the company? And how do I go about, yes, much of it will be the infusion of talent from the outside. But an equal companion of it is the building of the skill set of the employees in the organization to operate in a new way. So second thing, really important around capabilities. And then the last thing is around execution. And I talked at the beginning, as I said, I am really stunned by the degree to which you find companies whose entire orientation is around cost and earnings when it's just so clear how correlated the value of the company is to the sustained profitable growth rate of the company. But if you do decide to shift a company's set of focus and you do launch a whole set of initiatives that are designed to move the company from a growth perspective, the execution engine can't be underestimated. And whether that is the management system led by the CEO, the CFO, and their team that really ensures we're staying on track, or whether that's a very strong project management office or transformation office that does that, we really see a difference in terms of the quality of follow-through in folks that take that execution engine very seriously and folks that think it's just going to somehow happen in the regular day-to-day. So that's it. That's sort of the roadmap. The physics of growth, the mechanics of growth, and the enablers of growth. I hope you found the way of thinking about it useful and gives you the sense of confidence that it is possible to change the growth trajectory of a company. It's possible to change the value of a company through approaching it in a disciplined way, and that there are very real and direct implications for the talent in the organization. And Chris Davis, Chris and I used to work together, and then he left us, which was very sad, but he's found a happy life that he'll tell you about. He's been exploring some of these concepts in financial services, and I think he's going to share a little bit of it with you. Thank you.
Is this on?